What's the formula for bond yield? Have you ever wondered how investors figure out what they can earn from bonds? Understanding the formula for bond yield is key to grasping how these financial instruments work. Let's break it down in a simple way. The bond yield represents the return an investor can expect from holding a bond. It is expressed as a percentage of the bond's current market price or face value. There are a few main ways to calculate bond yield, and each method provides a different perspective on the bond's return. First, we have the current yield. This is the simplest measure. It calculates the return based on the bond's annual coupon payments compared to its current market price. The formula is straightforward. Current yield equals annual coupon payment divided by current market price. This gives you the income return an investor would receive if they held the bond for 1 year without considering any price changes. Next, we move on to yield to maturity. This is a more comprehensive measure. Yield to maturity estimates the total return an investor will earn if they hold the bond until it matures. It accounts for all coupon payments, the difference between the purchase price and the face value, and the time left until maturity. The formula involves solving for the interest rate in a present value equation. The equation is price equals the sum of the coupon payments divided by 1 plus the interest rate raised to the power of the time period, plus the face value divided by 1 plus the interest rate raised to the power of the total number of periods. Since this equation can be complex, it is often calculated using financial calculators or spreadsheet functions. For a quicker estimate, there is an approximate yield to maturity formula. It can be calculated as yield to maturity equals the coupon payment plus the difference between the face value and the price divided by the years to maturity, all divided by the average of the face value and the price. This gives a rough idea of the annual income and capital gain or loss over the bond's life. From a capitalism perspective, these bond yield formulas reflected how financial markets operate. Prices fluctuate based on supply and demand, credit risk, and interest rate changes. Investors aim to maximize their returns by comparing yields across different bonds, balancing income with risk. Bond funds, which aggregate various bonds, provide diversified exposure to yield opportunities shaped by market dynamics. Understanding these formulas is essential for investors, institutions, and fund managers. It allows them to evaluate bonds effectively, price risk accurately, and allocate capital to generate optimal returns within the financial system. So, next time you hear about bond yields, you will know exactly how they are calculated and what they mean in the world of finance.